So, guys, good evening once again. We are going to be looking at the summary of the trades that we take in the course of the week. All right, we're going to be analyzing them, reviewing the theoretical concepts that support the analysis. Okay, but I want to discuss something briefly with you guys. I have said in one of my videos where I analyze corrective structure, I've made it clear there that 80% of the time, 80% of the time, guys, market is going corrective. So it is only 10% of the time that market goes impulsive. Do you understand now? So we don't want to trade in the period of 80% corrective structure. We want to trade when market is impulsive. That's 10% of the time. So if you now divide, let's say 24 hours, okay, divide 24 hours into a proportion of 80% and 10%. What is going to give you? Let's say 20%. Okay. What is going to give you? 20% of 24 is what? Divide this by 10, that's 2.4. Well, that is 4.8. Let's say 5 hours. It means that if you go by this theory, 5 hours out of 24 hours, that is when market will give you the real move. Okay, and the remaining 19 hours, the probability of market going corrective is there. Hello. The probability of the market going corrective in 19 hours is there. So it then means that if you are a day trader, you are expected to only trade 5 hours a day. 5 hours a day. If you are a day trader and you are trading more than 5 hours a day, you will be losing a lot of money. You will be losing a lot of money because by the theory I have showed you, 20% of the time market goes impulsive, 80% of the time market goes corrective. So by proportion, you take that percentage out of 24 hours a day, only 5 hours is when you should be having active trading. And then the question is this: which session are we likely to have these 5 hours of active trading? If you are to choose, then you know that in London session, you are likely you are likely going to get a push, and in New York session, you are likely going to get a push. But the question is this: the push you get in London and the push you have in New York, which one is a true reflection of the direction of the trend? In 80% of the time, New York reflects the true direction of the trend, because market moves like this, guys. You have impulse, you have correction, you have this, you get a push. Okay, you have correction, you have market moves down, you have the push. You have correction, okay, market moves down, you have the push. You have correction, market moves up, then you are coming down. Okay, so if you analyze this very well, you are going to make one, and if you backtest it, you're going to make one important discovery, guys. And that discovery is simple. Every time you are having this consolidation, guys, it's going to be Asian session. When London session comes, most of the time in an uptrend, it's going to push that market. Is that not an impulse? Is that not a push? But that is not a push you want to trade. Okay? You want to wait for this true push to happen. And in most cases, in an uptrend, it's going to happen in New York session. All right? New York session. So and the same thing is applicable here. You have this consolidation in Asia, you have this push down in London, you have this May push. in New York. The same thing happened here. London, New York. When this come, when London push up above resistance, it's going to grab liquidity and New York is going to push it down. Can you see? So this is consolidation, that is problem, reaction, solution. Problem, reaction, solution. Problem, reaction, solution. Problem, reaction, solution. So when you are able to recognize the problem and you see the reaction, then you'll be able to depict where the next move is coming. For instance, you see here, problem, reaction, solution. Okay, so it's very simple, guys. You see the problem, you see the reaction, and you see the solution. Okay, so that is that about the period you have to trade in a day. You don't trade the whole day. It's going to be boring. You are going to be tired, and if care is not taken, the profit you have made, guys, you get to lose them. You will lose them if you trade the whole day. Once you have cut your move, just stay by it. And another thing is that you must learn to focus on a particular setup that you know its probability of playing out is very high. You get me now? You must stick with a structure, a pair that you know, you understand the pattern very well, and the probability of it playing out is there. So based on that, I'm going to teach you one pattern this evening. One pattern, how to trade a reversal pattern. It's a very critical pattern that not many people know, but I'm going to teach you this evening, guys. Okay, but before we do that, I'm going to teach you, we are going to analyze together all the pairs, all the trades that we took this week. Why did we take them? Those trades, did they have theoretical backings? All the theories and concepts that we have learned, do they have those theories and backing? Well, are we just taking them, just like that? You get to review some of those trades. All right. So first and foremost, we're going to start with USD JPY. Oh, sorry, guys. Hello, are you still seeing my screen? Are you seeing my screen?
Yes.
Oh, Euro NZD, right?
Euro. Yeah, okay. No. Euro New Zealand.
Okay, that's Euro NZD. All right, let's move on. Let's start with, I think we started the week with Euro USD JPY. USD JPY. Yes, that was where we started. And when you look at it, let's do top-down analysis, guys. Okay, top-down analysis. You see this pair? Okay, go to weekly. All right, we have done it several times that we have seen this structure. You have seen an impulse, you see another impulse, you see impulse, correction, impulse. That's overextended. This is, and what type of corrective structure is this, guys, in the middle? What type of corrective structure?
WXY.
No, it is not WXY.
No, I think this is an expanding triangle.
Expanding flat. Expanding flat. This is not a triangle. This is a flat. Go back to the theory. Study it well. This is a triangle.
No, I'm still studying it,
okay.
Prof. Okay. Nat, because I'm still studying that.
Okay. When you have
Elliott theory, wave theory.
Okay. When you have an impulse, this is triangle. You have A, B, C, D, and E. Then you have another impulse. This is a triangle. When you have this pattern this way, this is what is called a contracting triangle. That is symmetrical and asymmetrical in nature. both sides are the same. Symmetrical triangle. Convergence. Symmetrical convergence triangle. Can you see it's converging? All right. When it is like this, impulse, and then you have this, you have this, you have this, you have this. What am I drawing? Don't let us go there. I want to draw an expanding triangle. I don't want us to waste our time. This is a USD JPY. Let's just go to Euro AUD. You see example of expanding triangle, guys. 4 hours. I don't want to waste our time. Let me just show you straight on. See expanding triangle in 1 hour. Okay. See an expanding triangle here. You see as it's going, it's forming expansion. Can you see? Here you have, after that impulse, after this impulse, you have 1, you have 2, you have 3, you have 4, you have 5, and then up move. If you study what I taught you on that triangle, I did tell you that most of the waves inside a triangle are three wave structure. But you can have a situation where you can have one wave that is impulsive there, right? So when you have to label this, this becomes with A, B, C, D, and E. But can you see how the triangle is progressing, is increasing in dimension? That is what is called an expanding triangle, guys. Expanding triangle. And based on that expanding triangle, I knew this wave is going to curve. Okay. I knew that this wave is going to curve. What did I do? I gave you this wave to the upside. I said it's going to come. And then what do you notice here, guys? Before this triangle is formed, what do you notice? You see 1, you see 2, you see 3. I'm cutting it based on proportion. I'm not just cutting it anyhow. I can't stop this one here. No, it has to be like this. All right. So this is a structure, 3 waves down. And then I told you in the middle, you have another 3 waves up. And where are the 3 waves up, guys? This is the 3 waves up. Where is it? You see the A push. And I told you A is equal to impulse, B is equal to correction, is equal to correction. And then you have the C here. Okay? And I told you with a measure of authority, guys, that after this wave C is completed, this market is going to go down. That is what I told you. And can you see that as soon as this impulse is formed, we now have a clue of where we are going. We have started our analysis, guys, because we took Euro AUD. We have a clue of where we are going. So when you see impulse like this, all you need to do right now is to take a fib of that impulse. Okay? After taking that fib of the impulse, you now target 61.50 to 61.8 on one condition. All right, this is what 50 to 61.8. The only condition you are going to take a trade at 60 to 61.8 is if the roadmap to getting correction to that place is truly reflective of corrective structure and not an impulse. Let me explain. You know, I like people to understand the theory very well. When you understand the theory very well, every other thing is simple. You have an impulse. You are targeting 61.8 of this impulse. Watch out. 61.8 of this impulse. So you want the market to go this way. You want it to go to 61.8, 50 to 61.8 and fall. This condition will only exist if and only if the correction to this place is just 1, 2, and 3, or 1, 2, and 3. If it's truly corrective to that place, no problem. At 61.8, you will get a move to the downside. Can I show you an example? Yes. Let's go to card CHF. Let me show you an example of what I'm talking about, guys. Card CHF. When this market was here, okay, after this impulse, we take a fib. Let's close the previous fib, guys. All right. Take a fib. Where did we target before we took this trade, guys? 50 to 61.8. But you see that the roadmap to get it to 60 to 61.8 is truly corrective in three-wave structure: A, B, and C. This kind of trade will take it to the downside without fear. Do you get now? This is an example of a situation where market just get to 61.8 and you take it down, because the roadmap to getting to 61.8 is truly corrective in nature and do not have a straight impulse that get to that 61.8. Do you understand? Now let's get to Euro AUD for you to understand what I'm talking about. Okay, what am I saying? You see the example I showed you. You have what here? You have impulse. If you now have one, if you have 1, 2, and 3, and this 1, 2, and 3 give you 50 to 61.8, you can take this trade down. But in a situation where after impulse here, you are getting another impulse to get to 61.8, guys, don't take it. Do not take it. If the first leg that give you 50 to 61.8 straightforward, straight on, is an impulsive move, this is an indication that there is going to be a complex corrective structure. That the corrective structure is not going to be a simple corrective structure. And in that case, after you have gotten it like this, you are going to get a three-wave corrective structure in the middle, and you have another move to the upside. That is the move that will catch it. That will catch what? 61.8 to 78% retracement before you have this move to the downside. Okay, these are the tricks that you're not going to see in any book, but I'm telling you raw. Do you understand now? You can see that the other leg now is pushing to that level. Do you see now? Now, remember, we are on Euro AUD. Let me give you an example. Do I have one sample? Yes. Let me give you NZD CHF. NZD CHF. Everything I've got to show you here, I have proof for everything. I have proof for everything. Okay, I have proof for everything. You see here, what is this? Impulse. This market got to 61.8, though corrective. What did I say? If you get to 61.8 correctively, I said you can take the trade, right? That's what I said. And if you take a fib of this impulse, where is this, guys? You are on 50 to 61.8. Here, you're going to take your trade to the downside. And you have caught how many pips here, guys? I've caught how many pips here, guys? About 98 to 100 pips. Okay? But now, watch something. As soon as you come back and you are finding it difficult to break this level, and these guys appear, this move appear in the structure, what does it tell you? It means that this one is telling you that you have will be in the middle, that expect another move to the upside to break this top to form your wave C. That's what you have seen here. Three waves here, 1, 2, and 3. 1, 2, and 3. What are you expecting? 1, 2, and 3. This last 3, guys, is going to be what? It's going to give you 61 through 61.8 of this move. So at the end of the day, this one will now be a WXY structure. Why is it WXY structure? 3 wave to the upside, W, 3 wave to the downside, X, 3 wave to the upside, Y. Okay, and after this Y, you will see that in most cases, this Y will end not at 61.8, it's going to end at 78. 78, can you see? So potentially, I am expecting SZDCHF to give me a corrective structure up to 78% retracement. When this market was there, here, I gave you this structure that this market is going to come to this area. And somebody asked me that if we know that this market is going to come to this area, why don't we buy it? What was my answer? I said, no, you cannot buy it because it's going to give you headache. What do I mean by headache? Do you see this impulsive leg? You see this impulsive leg? You are on a trade. You have this big buy. All at a sudden, guy, the market comes down, boom. And before you know it, it has hit your break-even or your stop loss. And before you know what's happening, the market has come back to your present level. What headache can market give you that is more than these guys? That is why this kind of wave, you don't trade it. Allow this structure to complete. How do you know the structure has completed? Let it break this top, guys. As soon as it breaks this top, that's grab liquidity from supply here. And this is W, X, and Y. How is the structure of WXY look like? You have an impulse, you have a 3 wave up, you have a 3 wave down, and you have another 3 waves up. So that is why, and you have the continuation to the downside. That is why we call WXY a 3-3-3 structure. A 3-3-3 structure. A, B, and C. A, B, and C. A, B, and C. This is W. So this wave, this A, B, and C, that is opposing this move to the downside. Of course, you know it's a correction, but that correction is opposing the move to the downside. That one is labeled W. And this one, A, B, and C, that is in the direction of this market downside is X. And then another 1, 2, 3 that is opposing this move to the downside is called Y. Of course, if this is W, you have this X, you have this Y. And when this Y is completed, the next move is this impulse to the downside. We have to continue to the downside here. This is how market moves, guys. And then what we are expecting here, guys, is not different. It's not different. So what you see here is you are seeing a 3-wave structure here, W. You have a 3-wave structure here, X, with a short C, and then you have 3-wave structure here, Y. As soon as Y get here, this is our target for next week. Next week, we're going to take this trade to the downside, guys. And once we take it from here, guys, we're not going to stop until we break this low, guys. Now coming here. Do you see now? That is example in NZD-CHF. So if you have impulse, you have 3 waves here. If these 3 waves get to 61.8, you are going to have this move to the downside. All right. But now, how do you know that when you are having this move to the downside, it's going to break this low and continue to go, or it's going to come back to the upside? The only way you are going to know is that instead of you to have a strong push like this, you are having impulse, you are having 3 wave here, if you are having a correction. Can you see? So you are expecting an impulsive move to the downside, but all you are getting is a corrective moves in 3 waves. So because this impulse, this supposed impulse has turned to a 3-wave structure, that will give you an impression that this corrective structure is not over, and you are going to therefore have another 3 waves move to the upside. And bear in mind that it is not a must that this final leg to the upside must be 3 waves. It must not be 3 waves. It can be 5 waves, which means 1, 2, 3, 4, and 5. And when it is 5 waves, you can no longer label this as W, X, and Y. Why is it that you cannot label it as W, X, and Y? Because you are having 1, 2, 3, 4, and 5 here. And you are having A, B, and C. You are having A, B, and C. So this is 3, 3, 5 structure. 3, 3, 5 structure. This 3, 3, 5 structure is called a flat corrective structure. Okay? So that's the difference between a flat corrective structure and WXY. WXY is 3, 3, and 3. Can you see? So if you are having, a 3 waves here, 3 waves in the middle, 3 waves here, it means it's a WXY structure. But if you are having a 3 waves here, a 3 waves here, and a 5 waves here, this is not WXY because it is 3, 3, 5 structure. It's called a flat corrective structure. And if this, in that case, is going to be like this, guys. It's going to be like impulse 1, 2, 3, 1, 2, 3, 1, 2, 3, 4, 5. So this is going to be, in that case, it's going to be A, B, and C. Because that's the labeling of a flat corrective structure. And you have impulse here, and then you have another impulse here. Do you understand? So this is very clear, guys. It will help you to identify a setup. Now we have seen an impulse. So what we need to see now is this is 3 waves here. You have 3 waves here. This C at times cannot be the same length with A. All right. And then you have 1, 2, and you are expecting the 3. Can you see the way I'm cutting it is of equal degrees? This moves upside is equal to this correction. They are of equal degrees. And then I'm expecting this next move to the upside that is equivalent to this present move. So when this happens, by the time it happens, it must have broken this top, it must have cut liquidity at supply here. And then we are looking forward to set to the downside. This is money for us next week, guys. Do you understand? Now let's go back to Euro AUD. See, each concept I want to teach you, I've got a pair, that have such concept. All right. So after we have identified that this is going to get here and it's going to come back. Okay. Why is it going to come back? Because we have seen here, you see 3-wave structure to the downside. That is W. Then we see another 3-wave structure to the upside, A, B, and C. Remember, a triangle is a corrective structure. All right. And I told you a corrective structure can stay in wave 2 and wave 4 and in wave B of a correction. A triangle can stay in wave 2 of an impulse, wave 4 of an impulse, and wave B of a correction. A triangle can never stay in wave 1 of an impulse, can never stay in wave 3 of an impulse, and can never stay in wave 5 of an impulse. It can only stay in wave 2, that is corrective, wave 4, that is corrective, and wave B of a 3-wave structure. That is exactly what you have seen here. That's exactly what you have seen here. This is an expanding triangle. And then after expanding triangle in the middle, you have A, you have B, you have C. Okay? And then you have these 3 waves down. Is what? Is A, expanded flat, is A, is B, and is C. Can you see? So what are you expecting to the downside? You are expecting a move to the downside. So if this move to the downside gives you 1, 2, 3, 4, 5, it then means this corrective structure in 3 waves is no longer WXY because this is 3 ABC, 1, 2, 3 ABC. This will now be 1, 2, 3, 4, and 5. So this one becomes, these 3 waves down becomes A, big A. These 3 waves up becomes big B, and then this 5 wave down become big C. So this becomes ABC structure. ABC correction. And from here, I'm going to make a move to the upside as a continuation move of what? Of this impulse. Simple. Can you get, guys? This is highly theoretical, and market moves following these theoretical guidelines, guys. But what of a situation where this gives a three-wave structure, guys? Let's clean up some. The chart is cluttered in a way. Let's clean up some. Okay. All right. So we have ABC here. What of a situation where this guy gives us this, guys? The situation where these guys give us 1, 2, and 3, 1, 2, and 3, then pulls down 1, 2, and 3. This one becomes a 3 waves down, W, then 3 waves up as a correction of this entire move, X, and then you have 3 waves down, Y. It means that this still remains a 3-wave structure and not a 5-wave structure. In that case, this structure will become W, X, and Y. And then from this, you have to move to the upside. Because I'm telling you, I'm just telling you now, I'm preparing your mind. Next week, you're not going to have Euro AUD move down continuously. With what I'm saying, it's going to make a corrective structure here. After this corrective structure, it's going to push down. Okay, so it then means we have 3 waves here, which is W. This corrective structure, we have X, and the push down is going to be Y. Do you understand now? So this is how you interpret the chart like a pro. Remember, I told you right from the beginning on this structure, guys, that we are going to have, anytime you are having a push in the market, watch out something. When you have a push in the market, all right, and you have this move, okay, and you have this move, the next thing is to expect upside. All right, the next thing is to expect upside. If you look at this now, guys, if you look at this, you look at this low, you look at this low, you see that this low is lower than this low. All right, you see that this low is lower than this low. But this move, if you want to fib it, this is the low. This is not the low. This is the biggest mistake that 95% of retail traders make, and even some acclaimed gurus in the market, they also fall victims. This is what we call orthodox low. This is the orthodox bottom. You can call it orthodox low, you can call it orthodox bottom. This is orthodox bottom, not here. So whatever happens here to break this low is part of the corrective structure of this move, guys. Can I come again? Somebody is saying that. What are you talking about? What are you talking about?
Please come again.
Yes, I'm going to come again. Now, what are you talking about? I'm going to show you some real secrets this evening, guys. Real secrets. You see this move? You see this move? Come this way, right? You see this 3-wave structure? It's a 3-wave structure to the upside. What I'm telling you in essence, after this 3-wave structure to the upside, you have another 3-wave structure here. What I'm telling you is simple, and I'm going to show you example in pairs where this is replicated. Okay, I want to have followers in YouTube, in Facebook, in Twitter, in Telegram, whatever, that wants to understand the market raw, want to understand it as it is happening. And you cannot get it if you don't have a functional understanding of Elliott wave theory. Watch something, guys. You see this move to the downside? After this move, it makes a reaction in 3 waves. What I'm telling you is that after this reaction in 3 waves, it now make another 3-wave structure that broke this previous low here. It now make this 3-wave structure that broke this previous low. Guys, what I'm telling you now is that when you are to take a fib of this impulse, guys, this three-wave structure you see here is not going to be part of your impulse. It's not going to be part of your impulse. Where does your impulse end, guys? It ends here. This is where your impulse ends, guys. And this is what is called orthodox bottom. Orthodox bottom. The orthodox low, or you call it orthodox bottom. Okay? Orthodox low or orthodox bottom, guys. So now, if that is the case, where should we fib? We should fib from here to here. Can you see that? When you now fib from here to here, where's your 61.8, guys? This is your 61.8. This is where you are expected to sell. But assuming you have not taken this course, or you are not taking this training, and you are putting your fib here, guys. Where's your 61.8? The 50 to 61.8 is going to be here. And when this market gets to this place, you'll be putting a sell. But you'll be surprised, market will push you to this place. Why? Wrong application of Fibonacci theory. You have refused to measure it at these levels. This is the levels. So whenever you see such a case happening in the market, that after an impulse, you see a three-wave structure to the upside that does not get to 50% to 61.8% retracement, you are not expected to take it. Why have I designed my system to only accept a retracement, a corrective structure that get to 50 to 61.8? The reason is that if this corrective structure, guys, does not get to between 50 to 61.8 at the first instance, is going to come down in three waves to break this low, and then the move to the upside will definitely start. That is example of what you have seen here. Look at it. Look at it, guys. This three-wave structure to the upside, 1, 2, and 3. Does it get to 50%? No. Does it get to 61.8%? No. I will not even take it to the downside. I'm not going to take this trade. So, because it does not get to the required retracement level, okay, that gives me signal that I can sell with confidence. Therefore, I'm going to leave this trade. Let it develop another three-wave structure to the downside, and I ask myself now, is this second three-wave structure to the downside, has it broken the starting point of the reaction of the formation of the initial three waves to the upside? Yes, it has broken it. If that is the case, I now expect a retrend to happen to the upside to now push to the 50 to 61.8 this time around. And then this last wave that is expected to form can either be in 5-wave structure or 3-wave structure. It can be in 5-wave structure. If it is in 5-wave structure, then you're going to have 3, 3, 5 structure. If it's in 5-wave structure, 3, 3, 5 structure, this becomes an expanding flat corrective structure, because at the top of this one is with A, bottom at this level here is with B, and then 1, 2, 3, 4, 5 is with C. And because this wave C has come to break this high, and then this wave B here has come to break this low, this becomes an expanding flat. And after that, you have your move to the downside. Do you understand now? But what if this form a 3-wave structure like other people? Okay, because you have 1, 2, and 3. 1, 2, and 3 in the same proportion. Then you are expecting 1, 2, and what? And 3. We are just expecting on Monday final push to the upside for NZDC, for Euro AUD. All right. This Euro AUD, yes. For this Euro AUD, for us to take a buy. Okay, this is daily, sorry. All right. You know, I was telling you that we need to have a move to the upside on Euro AUD. But right now, for that move to the upside, for it to be actualized, guys, we need to complete this corrective structure to the downside. One in the middle, remember this is the triangle, and then you have this move. Catch liquidity as this demand, boom, to the upside. We are going to catch this trade live. Now, this is daily. We have done the analysis in daily. Let's go to 4 hours. Now, we are not concerned with everything right now in 4 hours. We remember what we are concerned about in 4 hours is just for these waves to come down to this level, guys, for us to make a move to the upside. And how is it going to make that roadmap to get to this level? It's simple, guys. We have identified a 3-wave structure to the downside, 3-wave structure to the upside. We are expecting either a 3-wave structure or 5-wave structure to this level. And by the time we get to this level, guys, we are expecting this push to the upside. This push to the upside. And this can be WXY structure. Why will it be a WXY structure? Remember, we have captured this as 3 waves here. Okay, we have captured this as 3 waves here. This is zigzag. Okay, these 3 waves is zigzag. And now we are looking for these 3 waves to the upside. And let's now break it down. Okay, let's break it down. When we are breaking this structure down, you'll be looking at it in terms of the proportion. How are they forming? What is the size of the impulse? What is the size of the correction? Those are the things you should be looking at. Do you notice that this wave here, guys, these waves here that move to the upside is equivalent in size to this one? Can you see? So if it is equivalent in size to that one, it means that this is A, B, and C. That's what it means. Okay, this is A, B, and C, because this leg here is equivalent to this leg. And therefore, the reason why I comfortably told you guys that this retracement is going to get to this level, okay, that this retracement, guys, is going to get to this level. You know why? I'm going to show you now. We are going to take a fib. It's not only impulse that you take a fib. You can take fib of a corrective structure. So take a fib between this wave, between this length to this length. Guys, where is 50 to 61.8, guys? Look at it here. Can you see? This is 50 to 61.8. Look left, guys. What do you see here? This level. What do you see here? Excess demand over supply. So market is likely going to come and catch liquidity at this level. Do you see a psychological level here? Yes. 1.4700, guys. That is the level. So is there any confluence on the part of the corrective structure that shows that this market may likely get here? Yes, we can do that. What can we do? We have to do what is called trend-based fib extension. You take it from here, from these 3 waves down, drop it at the end, take it to the beginning of this leg. Where is 100% to where is 1.0 to 1.23%? This place, guy, can you see a lot of confluence I have brought to this market? This is the analysis. This is the analysis. Are you getting it now? So there's no way you can do without fib. I know where I'm going on the higher time frame. I know I must break this level. I must break this level to form expanding flat at 61.8. Okay, if that is the case, this wave here is equal to this wave here. Okay, if that's the case, then I need to correct these 3 waves here. And what is the correction? The correction is simple, from here to here. Where is 50 to 61.8, guys? It's here. And for me to have a better confluence or another confluence that is where market will get to, I need to analyze the corrective structure that is coming there. And I have analyzed it, and I have discovered that this is forming a WXY structure. And then what I have to do to check if this confluence is there is I have to do what is called fib trend-based fib extension. And how do you do it? What do you want to achieve with that, guys? What do you want to achieve with that? You want to ensure that the size of these 3 waves to the downside is equal to the size of these 3 waves. And how can you ensure that the size that is the same? The length is the same. You do trend-based fib extension. Pick it from here, drop it to the end, take it to the end, drop it, and that's all. 3 dropping, and then you now measure the gap between 100% to what 123%, and it's exactly this confluence. So, guys, Euro AUD has no direction for now than to come to this level. If it does not come to this level, guys, it is not going to make a reasonable upside. What do I mean? If it comes like this, guys, let's say it comes like this after this 1, 2, 3. If you now make 1, 2, 3 and push up, it means that this is part of the X structure. It means that this is 3-wave structure in the middle. Then this will be W, X. Sorry, let me draw it properly. Let me draw it properly. You know, you have this 3-wave structure here. If you have 3 waves here, if these 3 waves come, and on Monday, you are having another 3 waves here, remember, it's not the upside we are looking for. This is in X structure. This will still be a 3 waves down, which is W. Remember, this is also a 3 waves up because it has formed 3 waves up, 3, W, X, and Y. So this W, X, and Y is a 3-wave structure that is this is W in circle, X in circle, and then you now need 1, 2, 3, Y in circle. Okay? And after that, to now come to the level we are looking for. So in that case, it may likely push down. If this push up, to break this top, forget it. It's going to push down very well. Then from there, you now have a move to the upside. This is Elliott wave theory in practical application. But I am not sure. I don't believe that this pair will make this move to the upside before it pulls down. No. All right. It doesn't have to make a bigger structure. This structure are equal. Then we expect this structure can push like this and now push down. So it still become W, X, and Y structure. And this 3-wave structure is complete, and we have this move to the upside. To target where? 650 to 61.8 of this previous impulse, guys. This previous impulse. Okay, 50 to 61.8 of this previous impulse. You know, this is our orthodox bottom. So we are targeting this area. Boom, to make a move to the downside. So another trade that we took, guys, is Euro NZD. Euro NZD. Where's this? Euro New Zealand. Of course, they have the same structure. They have the same structure. Okay. But the structure of Euro New Zealand, guys, is slightly different from the structure of what? Of Euro AUD. Let me explain to you. You have this structure. I want somebody to tell me, somebody to unmute himself and tell me this structure. Oh my goodness. And then you have this structure. I told you when you're having a pullback in 3 waves, I have another pullback in 3 waves to break this low. What are you expecting? Move to the upside to break this top. Okay. And after you have this, you are now having 1, 2, 3. First and foremost, this is a practical class. What type of structure are you seeing here? Somebody who knows to unmute and tell me what type of structure. Leading diagonal. Yes, this is a leading diagonal in wave A. If you study my my video on YouTube on impulse on motive waves, I have told you that motive waves has 2 types. We have an impulse and a diagonal. Okay, an impulse is a situation where you have 1, 2, 3, 4, and 5. Okay, but you also have another motive wave which proceed in the direction of the wave, but not in the form of 1, 2, 3, 4, 5 like this. It's also labeled in 1, 2, 3, 4, 5 because it's an impulse, but its configuration and structure is not like this, in the sense that wave 4 of a diagonal cut into wave 1. But in the case of an impulse, wave 4 never get to the territory of wave 1. Look at it, 1, 2, 3, 4, and 5. This wave 4 here never gets to the territory of wave 1. It must stop here. But in the case of a diagonal, you have 1, 2, 3, 4, 5. Can you see? This is a diagonal. Why? Look at wave 1, wave 2, wave 3, wave 4, wave 5. Look at wave 5, wave 4 here. Look at wave 1. Wave 4 is even crossing wave 1 to the upside. This is what makes it a diagonal. Do you get it now, guys? So you now see, I now told you that an impulse and a diagonal can only be seen in wave 1 of an impulse. You can't see it here. You can't see it in wave 2. You can see it in wave 3 of an impulse. You can't see it in wave 4. You can see it in wave 5 of an impulse. Okay? So you can see impulse here. You can see diagonal here. You can see impulse here. You can see diagonal here. You can see impulse here. You can't see diagonal here in wave 3. And somebody will ask me now, why can we not see a diagonal in wave 3? We cannot see a diagonal in wave 3 because wave 3 is usually very fast. And diagonal is a slow move. It's a slow move in the direction of the wave. So a slow move in the direction of the wave, you are not going to see it in wave 3 of an impulse. Do you understand now? So diagonal can be seen in wave 1 of an impulse and can be seen in wave 5 of an impulse. And then after a 3-wave structure is formed, you now have A, B, and C. Okay, in this A, B, and C, I have told you severally, if you watch my video on Elliott wave theory, just search Nathaniel Tunde channel, go to playlist, you go to under education, you see Elliott, Elliott wave theory. Watch my video on impulse and correction and all those things, you will get the gist. Okay, now I have told you severally that A is equal to an impulse, B is equal to a correction, and C is equal to an impulse. So if I have told you that in wave 1, wave 5, you can find impulse there. Okay, and you can find motive wave there. You can find impulse. You can find a diagonal. Okay, and then when you find a diagonal in wave 1 of an impulse, okay, if you find diagonal in wave 1, it is called a leading diagonal. If you find diagonal in wave 5, it is called an ending diagonal. And I've told you, since wave A is also an impulse, anything you can find in wave 1 of an impulse, you can find it in wave A of a correction. Anything you can find in wave C, in wave 5. Wave 5 is the end of that impulse. Anything you can find in wave 5 of an impulse, you can find it in wave C of a correction. Therefore, if that is the case, if you announce this one as wave A, 1, 2, and 3 is a correction, and then you are expecting 1, 2, and 3. So this, therefore, is a correction. We are looking for ABC corrective structure here. And this one right here, real quick, guys, is what is a leading diagonal. Is found in wave A. And how is it a 5-wave structure, guys? Look at it. 1, 2, 3, 4, and 5. Do you see that 4 has cut into 1? Look at it. Look at it, guys. This is wave 1, wave 2, wave 3. Can you see wave 4? Wave 4 has crossed the level of wave 1 to the upside. That makes this structure a diagonal, guys. And then you have wave 5 here. And after this diagonal, what do you have? You are now having 3 waves up, 3 waves down, and an impulse. This is A, B, and C. Why don't I call it WXY, guys? Why don't I call it WXY? Why don't I call this middle WXY, guys?